4. Scalable. With the right tools and automation, spatial arbitrage can be scaled to generate consistent profits. Many traders use bots to monitor price differences and execute trades automatically. Challenges in crypto arbitrage. While crypto arbitrage is profitable, it is not without challenges. Here are some of the most common obstacles. 1. Transaction fees. Exchanges charge fees for deposits, withdrawals, and trades, which can eat into profits. It's essential to factor these costs into your calculations. 2. Withdrawal limits. Some exchanges impose limits on how much cryptocurrency you can withdraw in a day. This can restrict your ability to capitalize on arbitrage opportunities. 3. Execution speed. Arbitrage opportunities often last for only a few seconds, so speed is crucial. Manual trading may not be fast enough, which is why many traders use bots. 4. Regulatory risks. Different countries have varying regulations, which can complicate cross-border arbitrage. It's important to stay informed about the legal landscape in the regions where you operate. 5. Market volatility. While arbitrage is generally low risk, sudden market movements can still lead to losses. For example, if the price of a cryptocurrency drops significantly between the time you buy and sell, you could end up with a loss. Tools for successful crypto arbitrage. To succeed in crypto arbitrage, you need the right tools and resources. Here are some essential components. 1. Arbitrage bots. Automated trading bots can monitor multiple exchanges and execute trades in milliseconds. These bots are essential for capitalizing on fleeting arbitrage opportunities. 2. Exchange accounts. Open accounts on multiple exchanges to take advantage of price differences. Make sure to choose reputable platforms with high liquidity. 3. Real-time data feeds. Use platforms like CoinMarketCap or CoinGecko to track prices across exchanges. Real-time data is crucial for identifying arbitrage opportunities. 4. Secure wallets. Ensure you have secure wallets to store your cryptocurrencies during transfers. Hardware wallets are recommended for long-term storage. 5. Risk management tools. Implement risk management strategies to protect your capital. This includes setting stop-loss orders and diversifying your portfolio. Step-by-step guide to spatial arbitrage. If you're new to crypto arbitrage, here's a step-by-step guide to help you get started with spatial arbitrage. Step 1. Choose your cryptocurrencies. Focus on highly liquid cryptocurrencies like Bitcoin, BTC, and Ethereum, ETH. These assets are traded on multiple exchanges and have narrow bid-ask spreads. Step 2. Open accounts on multiple exchanges. Sign up for accounts on at least 2 exchanges. Make sure to complete the verification process to avoid withdrawal limits. Step 3. Fund your accounts. Deposit funds into your exchange accounts. You can use fiat currency or other cryptocurrencies to make your initial purchase. Step 4. Monitor price differences. Use real-time data feeds or arbitrage bots to monitor price differences between exchanges. Look for opportunities where the spread is greater than the transaction fees. Step 5. Execute the trade. Buy the cryptocurrency on the exchange where the price is lower and sell it on the exchange where the price is higher. Make sure to account for fees and withdrawal limits. Step 6. Withdraw your profits. Transfer your profits to a secure wallet or exchange. Repeat the process to capitalize on additional opportunities. Conclusion. Crypto arbitrage is a proven strategy to generate profits in the cryptocurrency market. While there are several types of arbitrage, spatial arbitrage is the best strategy for most traders due to its simplicity, low risk, and scalability. However, success in arbitrage requires careful planning, the right tools, and quick execution. As with any investment strategy, it's important to do your research and understand the risks involved. With the right approach, crypto arbitrage can be a lucrative addition to your trading portfolio. Disclaimer: trading cryptocurrencies involves significant risk, and you should only invest what you can afford to lose. This article is for informational purposes only and does not constitute financial advice.